Hello, Namaskaram. Today we are with another podcast. I'm inviting Ashish Somaya sir for the podcast again, second time. Thank you so much for taking time out for coming to Kochi and the same time
Thank
giving
you.
giving time for this podcast. And last time also I learned a lot.
Thank you.
And even my audience also learned a lot. There was a good reaction for your videos. Just to introduce Ashish sir, his experience in stock market itself about 25 plus years. And he was with ICICI AMC about 12 plus years,
Yeah.
even in product side and the sales side. Post that, moved to Motilal Oswal AMC. There he was a CEO and director there, MD there, right?
Yes.
Then there around 8 years
Yes.
you were there. Then now 5 plus years successfully running White Oak Capital Limited. And I have always watched your podcast, and not only that, from your Motilal days, your newsletter and everything gained a lot. And
Thank
I'm
you.
sure, thank you so much. Thanks, sir, for coming out for today's podcast. And as I discussed, the theme for today's discussion is mutual fund versus PMS versus AIF.
Sure.
And mainly what we are trying to talk about is that how rich people manage the portfolio, or a person who is aspiring to be a rich person, how they should manage it.
Absolutely.
So quickly speaking, what is a real difference of thinking? Because you have seen private wealth, you have seen how a big HNA group
Yeah.
invest. So what is the real difference, a retail person and what is a rich person see the market as a whole in investing?
See, I think first of all, somewhere there could be this perception, right, that people who are well endowed, people who are rich, they may have more risk appetite, and that they may be more knowledgeable about the market. And there could be this perception that people who are not as rich or not as well endowed, they should not take risk, or they cannot take risk, or that they may have less understanding or less gumption related to the market. So first of all, there is no such thing.
Okay.
In fact, I always remind people that in last 20 years, twice the Nobel Prize in economics has been given to people who study human behavior.
Okay.
Right? If the Nobel Prize of economics has to be given to people who study human behavior, it means that while we think that the stock market is all about economics and mathematics and science, on the other hand, the Nobel Prize has been given for economics to people who study human psychology,
Okay.
which means that it's not only about economics and maths and science, it's a lot about how we control our emotion and how we control our psychology or our behavior when we are interacting with the market. And you can understand that it doesn't matter whether you are rich or not so rich. Emotional control and psychology
Okay.
is, sometimes people may not have a lot of money, but they may be emotionally very strong.
Okay.
And sometimes people may have hundreds of crores, but they may be emotionally fragile.
Okay.
So somebody may have 20 lakh rupees.
Okay.
And when the stock market goes down, sometimes the 20 lakh can become 15, 16 lakh. And they are fine with it. They don't lose their sleep. They know, okay, this is how the market works. Eventually it will follow the earnings. It will come back. But somebody may have 200 crores and the value goes down to 190 crore. They will lose sleep at night. So first thing is that, I think that whether it is rich or not so rich, the point is that in terms of thinking about the market, etc., I'll come to that. But I think irrespective of the level of richness and irrespective about knowledge or understanding, most important contributor, as we all know, is your psychological or mental makeup and your emotion and how you react when market goes up a lot. When you make a lot more return than what you thought, how do you react?
Okay.
And when your portfolio value goes down, how do you react? That is what matters much more than your knowledge level or your level of richness.
Okay,
Right?
okay,
I think
okay.
that is one. Second thing, what I've seen is that yes, it is true that when the pot of money becomes bigger, more opportunities open up. That is a fact.
Okay.
See, look, because if we are investing few thousand rupees or few lakh rupees, right, then I think the best is that either people take your help and buy some good shares, or again they take your help and invest in some good mutual funds. So when you're investing few thousands, few lakhs, those are pretty much the doors that are there. I mean, you can put money in a bank, you can put money in some government schemes, you can buy and sell shares, you can put money in a mutual fund. But the moment the pot of money becomes bigger, right, it becomes, let's say, more than few lakhs, it becomes few crores. Then you understand that, okay, if you have few crores, then real estate is also not just for living, it also becomes an investment option. Then, alternate investment funds, like you mentioned, venture capital funds, funds which invest in commercial real estate, pre-leased real estate, right? Funds which invest in private equity, growth-oriented or private credit, or portfolio management services. Then, investing through Gift City, investing outside the country. So it's not about how people think, but yes, it is true that when the amount of money increases, more number of investment avenues kind of seem to open up. That's the difference.
Okay, so basic fear and the greed, everything is the same almost.
Yeah.
But
that never changes.
So another thing is that they have more venues to look after when they have more money in their bucket.
Money,
Okay. So now the situation is in market from 2004, last quarter onwards, we are seeing a downtrend, right? And it's almost, it's reached 1 year plus.
Oh, yes.
Yeah, and we have seen minus return now this year.
Yeah.
So this is a situation where we have a lot of panic.
Yeah.
And we have a situation where, my fund is not moving. But my expectation was that I will get about, pretty decent return.
Absolutely.
And so what do you see the market? Because now we have a Trump is coming, we have a Russian war is coming. So if you can put very, structure around what's happening in the market and where do you, then we will move on to this one, because since we got you, I think this is one important thing which we can extract from you.
Yeah. So, I'll speak about the market and what you mentioned, but on our previous question, I just want to make one more point. We both of us, we did discuss that when somebody has more money, then more investment avenues open up. But greed and fear cycle remains the same. So I just want to also say that just because more investment avenues open up doesn't mean people make more return, because more investment avenue means more confusion. So that also happens, right? So ultimately, nothing beats long equity and nothing beats a good equity mutual fund, right? If you're consistently investing for long term, we're living in a stock market where market itself has compounded 14-15% year on year for last 30 years, right? So if you're in a disciplined manner, if you invest long equity, then you can make the most of it. So it's not that if you have more money or less money, you will make more return or less return. In fact, sometimes people have a lot of money, but they make mistakes and they get confused with the plethora of investment. On the other hand, somebody might be doing a simple SIP for 10-15 years and they might actually get a higher compounded return. That also happens. Now, coming back to our discussion about the markets. So you're right. I think people have seen market going up a lot. People have seen market going down a lot. But not many people have seen market going nowhere for such a long time. And now, it's from August 2024 till, October 2025, which is not very normal. I mean, yes, people like you or me who have been around for 20-25 years, we have seen that 2001, 2, 3, nothing happened. 2010, 11, 12, 13, nothing much happened. So we have seen bouts of time, like, even from beginning of 2018 till end of 2020. Ultimately, market went down. I mean, it didn't do too much for like a couple of years, and then with COVID, it fell. So this is also a period, where some of us have seen that market goes nowhere. But for many other people, it can be unnerving because they are used to seeing some return, or they are used to at least seeing some excitement when market goes down. But they've not seen a market which has, the entire day passes and the movement is 0.4%, 0.5%. I mean, somebody was pointing out to me a statistic that for weeks and weeks together, or for days and days together, the market didn't even have a 1% movement. Every day it was 0.5, 0.7, 0.4 up and down, right? So, and volatility, what we track with the VIX, has been like a historic low level of volatility. But the good news, what people should realize is that the beauty about the stock market is that if it doesn't move for a year, it becomes cheaper by 12 to 15%. Because if you see, let's understand 1 year back in 2024, we were worried about 5% GDP growth. The government was just out of election. People were not discussing Mr. Trump. People were discussing dynamics of coalition politics. People were worried about poor earnings growth, tight liquidity, high interest rates. These were the concerns. 1 year down the line, we are not discussing any more coalition politics. We probably have a stable government in the center. GDP growth forecast has not gone to now 5 or below. It is upgraded to 6.9%. Our sovereign rating has been upgraded after 18 years. Corporate earnings is not as good as it should be, but from nearly zero, it is at least now single digit. And that is for the index. The portfolios we own probably have 12 to 13% EPS growth projection. Interest rates are down. Government policy on the fiscal has changed because government is cutting taxes and cutting GST. So I would say that compared to 1 year back, if 26,000 1 year back people were queuing up to invest, then today at 24,500 Nifty, they should not be worried because index is also down about 7-8%. Plus fundamentally the market has corrected by 12 to 15% because earnings have gone up and interest rates have gone down. So why is, despite some of these improvements, why is the market at the same level? That is, I think, because of the external environment, like you rightly said, Mr. Trump and the tariffs and the geopolitics. But look, I would just put it this way that we should not react or respond to that. And here I just have one small story to tell you.
Okay.
The worst of India and US relationships was maybe 1971, 1972.
Okay.
Mr. Richard Nixon was US president and Mrs. Gandhi was our prime minister. And at that time, we had a very confrontational, it was Cold War. We had a confrontational issue, right? So at that time, how the US thought about India and how they treated India's prime minister, we came to know when some documents got declassified after 40, 50 years. There was politics and geopolitics at play, but what was happening within four walls, you did not know. You came to know after a few decades has passed because the documents were declassified. Correct? Mm-hmm. Now you can read those documents and say, oh my God, this is horrible. Right? Is this how we were being treated? Right? Now today what is happening? Today also there is politics and geopolitics and trade and tariff involved. But what is happening, unfortunately, what should be within four walls, there are many windows in those four walls. And the guys who are sitting inside the four walls are also tweeting. And they'll say, okay, Nikhil, if you do this, I will do this. If you do that, I will do that. So it's pretty much still a negotiation. It is pretty much still within the four walls. It's just that you are getting a lot of noise. And in today's world, just by seeing one tweet, let's say you put 2 crore rupees in 2020. Today it might be 4 crores or higher, right? You see one tweet, you sell the portfolio. You get 2 crore capital gain, 12.5%, you will pay 30 lakh rupees tax. Right? Because if you put 2 crore, it became 4 crore. So 2 crore capital gain. So 2 crore long-term capital gain, meaning 30 lakh rupees tax. Right? That's the tax, 12.5 plus surcharge. So you say, oh my God, I'm getting very nervous. Let me sell the portfolio. Sell the portfolio, 30 lakhs capital gains. Then you're feeling, oh, thank God, I'm out of the market. Next Monday, the guy tweets something else.
Positive.
Positive. Mr. Modi is my friend.
Yeah.
Right? Then what you will do? You will buy 5% higher.
5% higher.
And you already
pay tax also. So unnecessary, you have given the share of government, whatever it is.
Yeah, I mean, so what I'm saying that 2 crore is an exaggerated example. But I'm just saying
it can be true. I have seen 50 lakh people are playing with this.
Pay tax, right?
Yeah.
So what I'm saying is that this is what happens when you react to noise. It is still an evolving situation. You don't know. See, when we were in school, like when you and me and all, when we were in school and college, there was a World Trade Organization. WTO was being negotiated and all, right? Generally accepted trade and tariff practices, and GATT and WTO.
Yeah.
Which FTA gets negotiated in 3 months or 6 months? I mean, India-UK FTA has taken years. India, UAE, India, Australia, we have FTAs with many countries. It doesn't get done in 3 months or 6 months. And in that negotiation, if they keep sending you some message on Twitter and social media, you will keep buying and selling or what? What will you do? Right? So I've given you a long example. I don't think people should do anything about it.
Yeah, even another issue is that because now we have a thinking that market is still the same thing. And if something happens, but it's the same thing, right? Because I'm ready to buy if it's come down. because we think that it's not cheaper. We can get little more cheaper.
Little more cheap, yeah.
Yeah, so that is also another trigger that I'm sitting with money.
Yeah. Let me wait.
Let me wait to see the downfall. And that is also, I think this is a trend which I'm seeing another one. So let's keep it in
Yeah, but look, it's not like a train which will blow a whistle and start moving. right? I mean, the market goes up unannounced. It's not, see, in the last few months, we peaked, like you rightly pointed out, in 2024, we peaked at 26,200 Nifty. The worst we saw was for couple of weeks, when this tariff was at its height. Once we saw below 22,000, very briefly. So you leave the extreme of 26,200 and you leave the extreme of 21,700. The entire year index has been between 24,000 and 25,500. And like I pointed out, we cannot time it to perfection, but let's understand that if it is 25,000 for the full year, it is automatically 15% cheaper. So at one point in time, if the bottom was made at 21,700, now the bottom has to be 10 to 15% higher than the previous bottom, no? Because the fundamentals have shifted. The liquidity has changed. The sovereign rating has changed. The equity risk premium has gone down. Government's 10-year borrowing rate has gone down. The government's fiscal policy has changed. RBI has cut repo rates. Many things have changed. The US dollar has gone down. Right? So many things have changed. So now if you think that the next time also bottom will be 21,000, I don't know. Will it be 23? Maybe. Or
no, this is a bigger issue. And so follow to this one, we have this question that, timing and time in the market. And the same time, this question is like, should I do monthly or should I do one time?
Yeah.
So what is your thought, like, especially this time or generally, when we invest in market?
So, there is one big problem. Like if you as a advisor or if I as a mutual fund CEO, if we tell people don't try to time the market, some people might think, oh, this guy wants me to invest the money, so he's telling me don't try to time the market. So I always make it a point to clarify to people. When we say don't time the market, whether it is you or me, I think we are on the same page that you should not try to time the market. So we should clarify that when we are telling people not to time the market, we don't mean to say that timing is not important. Of course, timing is important. In hindsight, you would have wanted to invest in April 2025, no? Or better still, you would have loved to invest in May 2022 or March 2020. So we know that timing is important. But when the right time comes, the emotions overrule our better judgment. So timing is important, but doesn't mean that timing is possible or timing is easy. So, people should not misunderstand. When we say don't try to time, we are not saying timing is not important. We are saying that yes, it is important, but you will not be able to control your emotion and manage it appropriately. Correct? So coming to the other part, which is that, okay, keeping all this in mind, so I always, generally speaking, I always tell people that you should do a systematic transfer and drip the money over a period of time. And that is not just related to current environment. Current environment, definitely, I think you should do a 6 months systematic transfer plan.
We have 10 lakh rupees, we split into 6 or 10 and we...
so you do it fortnightly.
Yeah.
So, so in 6 months, you will have 12 installments. So 10 lakh rupees, if you, break it into 12 installments, so, 80,000 or whatever the number will be. But why I'm saying that is because whether it is you or me or anybody, if we are taking a boat and entering into the water with our boat, the moment the boat enters the water, if it is extremely rocky, then our entire journey will be stressful. Now, the most minor of turbulence, we will be like, we cannot enjoy this ride.
Especially person who investing the first time, they will have a big tension.
Yeah, see, you encourage somebody to put 10 lakh rupees. You have all the right intent. The person is investing for 5-10 years. You know that this is going to get a good return. Everything is in the right place. The advice is right. Everything is right. But what happens when the moment the journey starts, if 10 becomes 9, then it will always be on the watch. The 10 becomes 9, it will always be on the watch. Then okay, then the 10 can become even 14 and 15 lakhs. But again, from 15, if it comes to 13, then see, this investment is, is like this only. I am not comfortable with this because, every once in a while it is showing me, a difficult scenario and making me insecure, right? So once you start investing and the 10 becomes 9 with the best of intent, the problem is that if you see a big downside ab initio, then you remain insecure about that investment. You remain watchful. You'll never be able to sleep at peace. It will always be on your radar. The next hint of trouble, you are most likely to say, okay, let's get out of this. I can't take it one more time. Right? So on the other hand, if somebody has dripped the money in a systematic transfer, over 6 months, maybe, their return will be average.
Average.
Because sometimes it can happen. You put 10 lakhs and next month 10 has become 11. But that's a rare occurrence. If you drip it over 6 months, at least you will not have a rocky start. At least you will not have a turbulent start. At least you will have a smooth start. When people have a smooth start and they see for the first 6 to 12 months, the journey is uneventful, then they might stay longer. Then it's not on their watch list all the time.
Correct. No, even this one, especially when we invest for NRIs,
Yes.
if you're parking entire money into debt fund,
Yeah.
then it's a TDS happens.
Yeah.
So this is the tension. So ideally speaking, from what you said, like giving an experience that TDS is okay because only going away from your earned
Gains,
income.
yes,
Yeah, it's
yes.
not like from your capital.
Yeah.
This is also a tension. Otherwise, we need to think about something like arbitrage fund or something. But
Yeah.
this is sometimes we have this tension.
Yeah.
And unnecessary
I get
TDS is going.
But see, I think ultimately in any form or format, if there is a TDS, you have to file the return and you have to, the 26 AS and all, you have to take the credit. Now, there is one entry or multiple entries. I know it is a bit of administration for a chartered accountant. But I think it's not that much that you will not take care of the investing experience itself. Basically, I want somebody to stay longer. And my belief is that people will stay longer if their investing experience is less turbulent. That's why I thought that way.
No, this is a good. Sometimes the only thing is a very rare occurrence. If shoot up 10%, then we will miss that opportunity. But again, a person definitely for the first 3 months he will look on the app and see that what is my return.
Exactly.
That is a time if they're seeing that immediate downfall, then they lost the confidence. And so, given this point, it is very important that we need to be in market. Maybe we have that.
If it is down, then not once a day. People will open the app every 1 hour.
Yeah, every 1 hour. And
In 1 hour, even the NAV doesn't get updated, but still they'll have to see.
Yeah, even my one of my clients.
Yeah.
So a doctor who was very happy in FD, and one fine day he entered into market. And he said that earlier once a patient goes from his cabin, he just take a stretch and do all these things. Then after that he started looking at the phone. So he was telling that earlier, even if he gets stressed, he just maybe bit of dance or something, then he get charged up and do
Charged up, yeah.
But then he started watching this portfolio and he started getting that lot of tension. Then I said, now you come here. My only request is that take out that app from your
delete the app.
delete
exactly.
the app. Yeah. And that time he was doing a little bit of a trading also. See, opening an account is a very easy thing now.
Yeah.
But then he was telling that the moment I pick the stock, it comes down. Then the moment I sell it, stop loss hit or I sell it, it goes up. So then he started. Then we said, what you want is that a better return than FD. That is only expectation. And then I said, why are you investing? He said, I'm investing for long time. Then if you are investing for long term, why do you want to check on the
check every day?
All the day. But then we moved him to enter into mutual fund. Then I said, first of all, understand that there is 1 year is a tax break. So after 1 year only we think anything.
Absolutely.
Then I don't.
And the NAV will come only next morning.
Yeah. Then you don't have. I said first 1 year because anyway that time he moved only very less percentage. I think 10 or 15% of FD into this one. So why he need to look? And he said that it is very clearly for 7-8 years. So this is a bigger tension.
Yeah.
So tell me something. What is the main reason, according to you, people need to be part of market? What is they going to miss?
No, see, of course, look at it this way that, when it comes to our country, when it comes to India, one of the things which is cited, as far as the economics is concerned, it is always cited that, we are going to witness the equivalent of an Amrit Kal in the next 20-25 years. And sometimes it might sound like a marketing propaganda, but according to me, it is completely mathematics. It's not market. It's not a propaganda. And the simple reason to be in the market is that if we are expecting that next 20-25 years will be the best of India's economic performance, we should also know that India has a long history, like more than 30-35 years history, where the rate at which the economy has grown, at a comparable rate, profits of big companies have also grown. And the rate at which profits of big companies have grown, that is the rate at which the index, like Sensex or Nifty itself, has grown. So all of us are thankfully living in a country where economic growth of the country at large, the economic growth translates into growth for corporate profits. And corporate growth translates into stock market performance. So thankfully, we have an ecosystem, we have a regulatory structure, we have an economic or a capital market structure, we have institutions, we have law of the land, whereby we have the ability to not just talk about our economic growth, we have the ability to directly participate in that economic growth. Look, there are many countries, let's say, which are largely owned by the government or largely owned by few conglomerates, where economic growth does not necessarily translate into growth in corporate profits. And there are many countries which don't have these institutions and capital markets and wealth managers and law of the land, where corporate profit must translate into stock market profit or your mutual fund NAV. So we are blessed to have such an economic structure where the economy is linked to corporate performance, is linked to market performance, is linked to your mutual fund NAV. So we must, the simple reason to be in the stock market is because you want to participate in the economic growth. You and me are contributing to the economic growth, right? The people who are today 20-25-year-old, in the next 20-25 years, India will have the biggest consumer force and the biggest labor force. We are definitely going to be the biggest driver of growth in the global economy. We are already in the top 3 contributors now, right? So if we can see it in front of us that our economy is going to grow at a faster rate than any other economy, if we can see it in front of us that we are going to see a lot of wealth creation, and we have the wherewithal and the ways and means to translate it into our own portfolios, then why would you not participate? You have to be really crazy not to participate, if you ask me. Of course, you should be mindful about how to participate, whose advice to take. You need to find the right modus operandi. But I would be surprised if somebody said that they don't want to participate in the growth.
Being market is definite, and how is the only question we have.
Yeah, exactly. And you are running a business, I am running a mutual fund company. You said you are dealing with some doctors who are clients. I'm sure you must be dealing with some other professionals. All of us are contributing to the economic growth. But how do we participate and benefit out of it? Should I benefit out of it just by drawing some salary, or can I benefit from the overall growth of the economy and other multiple sectors? The only way to do it is through the stock market.
Even especially in Kerala, we have people working outside, and they are seeing that this opportunity. Many people say that in this country I don't have an opportunity to invest. Let's say it can be Middle East, it can be.
So you, let's say, you gave a class. Let's say if somebody is in the Middle East, right? Of course, the bulk of the economy is owned by the kingdom or by the government. The biggest businesses are owned by the kingdom or the government. The biggest businesses, they don't have a thriving stock market. They don't have a thriving private sector. So that's a classic example of a country or a region where economic growth may not necessarily result in opportunities for you to gain out of it. Right? You may gain because of salary or something. But the biggest of companies may not result in stock market performance, whereas India actually has that economic structure. Right?
And we have a regulatory system because especially these countries, regulatory system, may not be as good as
it may not be at par. Because see, in India, what has happened is that we all are American educated, like in terms of capital market, in terms of investments, finance, capital market, we have the best exposure because that the US is it's like a capital market or a capitalistic society for a couple of centuries. And India, the evolution of India's market is actually comparable, maybe a few years behind, but actually comparable. Whereas some of the other markets that we are giving examples of, they don't have that kind of structure. A simple example is, respect for minority shareholders. Correct? If you don't have, if companies, whether they are government companies or private companies, if you don't have law of the land and if they don't have respect for minority shareholders, it will not result in stock market performance. It will not result in your NAV being, appreciated.
Meaning that any person who is investing 500 rupees also get the equal respect
Yes,
as
they have the rights.
anyone.
Yeah. In our country, they have the rights, but not necessarily in all countries.
Okay. Because we have a set of people can come from Australia to some of the European countries to so we have that confusion that whether I should invest in that country or this country. So what will be the participation?
See, take an example of Europe. Europe has our kind of economic and capitalist structure. They have the institutions also, but they no longer have the growth.
Okay.
Right? They are aging. Those economies are aging. They are surviving because they became very rich before they became old.
Okay.
Right? But for us, the best is in front of us because we have a young population. We have the best of economic growth ahead of us. But the entire economic plumbing and the capital market and the institutions are already preceded. That is already in place.
Okay.
So we have the mechanism to capture into our portfolios. We have the mechanism to capture into our portfolios whatever growth lies in front of us.
Okay.
So I think that, and say you mentioned, say Australia, I mean, they don't have the kind of population and diversity of the economy. So some countries don't have the local economy itself.
Okay. Yeah.
Some countries have the economy, but they don't have growth.
Okay.
We have the local economy, we have the growth, and we have the entire economic structure to benefit out of it in terms of our own portfolios.
Okay. It's a great point. I think we also can be partner with the country's growth, and when we look at from a people point of view, so especially my audience will be keen to see that how they can reach 1 crore rupees. And so definitely SIP is one route which we always say. So how do you can link with reaching 1 crore with before 1 crore journey? So reaching 1 crore with SIP and top up SIP, and because you have done a lot of study in that White Talk also. Yeah. So you could put some insight onto that. That will be great.
See, 3-4 things. First is that everybody speaks a lot about stock market and about mutual funds and what type of returns they can get. But let's understand that returns is a measure of output or efficiency of the output. There is no point in discussing the output or the efficiency of output without giving due input. Right? So the first thing is that how much you save. See, we can deliver, the history of mutual fund industry and of our market. Right? The industry has delivered, equity funds have delivered, our market has delivered, all that is fine. Sometimes the market goes up faster, sometimes it goes up slower, right? But the point is how much you invest. So I think for anybody who has a goal to collect 1 crore, correct, they should be investing few lakh rupees every year. So first you need to understand that 1 crore in how many years, how much are you going to invest per month, and how much risk you can take, where will you invest. If you say that, okay, I'm going to invest 5 lakh rupees per year and I want to reach 1 crore in the next, say, 7-8 years, example. But I will keep money in debt funds. No, you'll have to take the risk of equity. That is not achievable with debt funds, correct? So how much you will invest, how long you will keep investing, and what type of risk you can take whereby you can aim for a higher return.
Okay.
But the key thing, whatever learnings we have had, the key thing is income minus saving is equal to expense. So you have to save first. First you plan how much you want to save to reach your goals. Tailor your expenses to your need of saving. Don't tailor your saving to your need of spending money. Second is that you have to be consistent. And third is that you have to stay for the longer period. And I think that, Kerala is a very rich state. Yeah. And I don't think that it is that much of a challenge for middle class people to save 1 crore over a period of time.
Yeah, right? Kerala is a rich state, and at the same time, we have a lot of leverage, loans.
Okay.
So in any household, you have the statistics, right? Most of the household, we have cars or good mobile phones.
Okay.
And good percentages with the EMIs.
Right.
And this is the challenge which we have, that maybe for a person salary is 100 rupees. Maybe it can be like a 40% will be loan, or maybe more. Especially government servants, we can see that. I'm not really putting the name, but especially people who have a guaranteed job and guaranteed
income,
salary. So they have a tendency to have a home is aspiration. So then home loan is another responsibility.
So, how I would put it is that it's, like I personally, 40-50% proportion of income going into EMI is a bit high, definitely, because it doesn't leave much flexibility for the family, right? And then it becomes, difficult, because if you have so much of EMI, then you better have very solid insurance and so many things. So you will only end up putting more into insurance and medical and, so many things, because when you have such a high level of EMI, then there is not much disposable saving, which means that, you cannot afford any kind of medical emergency, or you cannot have any such, risks. Correct? So it puts everybody in a tight spot. So 40-50% of income going to EMI is actually a bit too much. But generally speaking, if you ask me, mathematically taking a loan and mathematically doing an SIP are same or similar concept. What happens is that when you take a loan and do an EMI, what is happening is that you are getting the benefit right now. I mean, whatever car or whatever mobile or whatever you wanted, you are getting it right now, but you are going to pay for it in future from your future earnings. On the other hand, if you do an SIP, there also you are paying monthly, right? The only thing is that you will end up probably accumulating a lot more, because when you pay EMI, there is no concept of appreciation in it. You are just paying the interest and the installment back to the banker. The bank borrows from you at 6% and lends to you at maybe 11-12%, right? So the entire appreciation is going to the lender. But on the other hand, instead of doing EMI, if you do SIP, yes, the big negative is that whatever you wanted, that will come to you down the line. But it will be yours. It will come faster. If you take a car and you say that, okay, I'm going to take a loan for say 6 years or 7 years or 5 years. I think typically car loans will be at least 5 years.
5 or 3 years, yeah.
5 years, 3 years, whatever people may take, right? The point is that if you keep saving that much, right, maybe instead of 3 years, it will take 5 years, but the car will be yours. And you might end up actually, with SIP and equity, what happens is that it happens very often that the return is more than what you anticipated, right? So I would say that mathematically they are the same thing. To take a loan and pay the EMI, you need belief in your future. To do SIP and create wealth, also you need belief in your future. The question is that in that whole process of inverting meaning here you are getting the consumption first and paying for it later. But in that case, the entire benefit you are passing to the lender. Whereas in an SIP, you are likely to accumulate much higher wealth than what was originally anticipated. And whenever you acquire what you want to acquire, it will be yours.
Yeah, perfect.
But both of them need confidence in the future earnings. And both of them need confidence in the future. Okay. The question is just which way the arithmetic is more beneficial. You have to
and your patience
careful.
Also, right? Yeah. And this is something which I always like to work with people who have a debt, because their discipline part is set. Because
discipline they have, but the maths is inverted.
Yeah, so if I have a few clients, still they say EMI for SIP. And then my people, when they call for review, they will say that EMI. Then sometimes when I listen to the recording, I can see that my guys are correcting them. Sir, it's not EMI, it's SIP. Then I tell them that don't correct them, let them tell the EMI itself.
Same, mathematically same thing.
But this is a big thing, because even I have seen that people who have started investing, they said that I want to buy land, I don't want to take a loan. So we started investing, and now they reach a portfolio of 2 crore. And I said, now your goal is achieved, 1 crore you can take and buy it. So they say that I don't think this is needed, because 2 crore, I don't want to.
Now you got the hang of it.
Yeah, so he said that because that person is in somewhere, and he's going to come back only after maybe
retirement.
15 or 20 years. So he's saying that let's hang on.
Yeah, exactly.
Then now he is becoming very sensible in terms of money aspect, not emotional. So these are the good things we do. So if you can touch upon when we do all these things, how much do you invest in equity? So asset allocation play a big role, especially when White Oak also doing fund in multi-asset.
Yes.
So if you can talk about the importance of having multiple assets in one one person's portfolio.
Yeah. So, see, broadly, what I do is that, of course, when you do when you do financial planning for somebody, when you do planning for goals or for future investment, of course, every individual will have their own risk return profile. Everybody will have their own goals. And for those goals, you will create their portfolios. And for each goal, there'll be different type of asset allocation and the portfolio will need to be created. So there it is, personal finance. I mean, everybody has a different allocation and a different type of portfolio so that you will plan for it. But leaving that aside, when you talk about people investing for 15, 20 years for growing their wealth or for retirement or for appreciation, in all of those cases, I generally tell people that there are two types of people. Either you're an equity investor or you are not an equity investor, meaning you need asset allocation. So what do I mean by equity investor? These are people who are investing for maximizing or for growing their wealth. And a definition of equity investor for me is not the person who, a lot of people say that they are risk seeking. But for me, whether you're risk seeking or risk taker or not gets determined how you react when the market is 30% down. So I may say that, I am a out and out equity investor and I may conduct myself accordingly. But the day Nifty goes from 26,000 to 20,000, I start calling you and say, what has happened? You should have removed my money at 26,000. You never told me. You are the expert. Now see my portfolio is down 30%. So if you cannot digest 20-30% down, and if you lose your sleep over, this kind of fluctuations, which happens once in 3 to 5 years, then basically you're not an equity investor.
Okay.
Equity investor is somebody who can forget about it, and who has this core belief. Like I said, economic growth results in corporate performance results in growth. You can correlate that and you are willing to stay put. That is needed for an equity investor. You should not lose sleep if the portfolio goes down. So if you are not that type of person, then you need asset allocation. That's very clear, because if you are 100% into equity, let me tell you, once in 3 to 5 years, 100 will become 70. And that will be the real test of your acumen. So if you're not an out and out equity investor and you cannot tolerate this 20-30% down, which happens once in 3 to 5 years, then you better have an asset allocated portfolio. Meaning a portfolio which will give you reasonable exposure to equity, but it will not go 20-30% down.
Okay.
It has to reduce your volatility. So then you need a combination of Indian equity, maybe gold, silver, REIT and InvIT, like real estate, and debt, fixed income. Because like nowadays people are asking, should we have gold in the portfolio, right? This kind of thing. Of course, in Kerala there's a lot of gold, but the point is in the financial portfolio we are talking. So, anybody who has an asset allocated portfolio, they might have 50% in equity, 40% in equity. And to reduce the volatility of 50% equity, you need some 15% gold. Whenever the opportunity presents, you may have silver or REIT or InvIT or whatever. So that's why I said, either you are a pure equity guy or you are an asset allocated guy. There's no other. And this asset allocation for people can vary depending on their goals. And if you do asset allocation, then you better do it in a scientific manner. Like a lot of what people will have, 50-60% will be in equity, 30% will be in debt, and some 5% will be in gold. That 5% gold is going to do nothing to the volatility of 60% equity. It is going to be ornamental only. It's not going to help anything. To cut the volatility of 50% equity, you need some 15-20% gold. So either you have properly allocated or you don't have properly allocated. That's the key thing. And asset allocation has to be done in a very scientific manner. Like you need to understand that how different asset classes behave relative to each other. Like today, if you tell someone that in an asset allocated portfolio you should have gold, they might equally tell you, yeah, but gold has gone up a lot. Why you want to buy it now?
This is a question. Now it's gone up. Is it the right time to buy?
Yeah. So what happens is, if you evaluate gold on its own, how it behaves will be very different with how it behaves when it is mixed with equity.
Okay.
See, if you look at gold on its own, you may say that it's gone up a lot, it will go down. But if you have a portfolio where you have 40% equity and 15% gold, the combination will behave very differently. Why? Because if gold doesn't do too well, there are good chances equity might be doing well.
Okay.
And interest rates might go down and even debt might do well.
Okay.
And currency might appreciate. So debt might do well. Right? So how you think about gold on its own versus how you think about gold when it is mixed with equity and debt and real estate and all, the net NAV movement and the net outcome is very different. If you invite me for a drink in the evening, I will be one person. But if you tell me to come with my wife, I will not be the same person, right? So it matters in whose company
whose company you are in. Yeah. No, I think it's a brilliant point, because even especially when we allocate fund for some people, right? Especially gold is definitely we consider, and based on the goal, we know that what is a kind of a horizon they need the money takeout. So this really play a big role in terms of keeping asset allocation. We spoke about mutual fund as a asset and everything, but what is after a mutual fund? So we have a lot of alternates these days.
Yes, of course.
So if we can talk about PMS and AIF, that is another topic of discussion in this today's discussion. So what is beyond PMS?
See, AIF is obviously a very interesting, very vast space, because AIF is, sometimes I say it's like a, in an AIF, you can pretty much do any kind of investment. Whatever, in fact, if you ask me, for example, White Oak, everything which we can't do in mutual fund, we do in AIF.
Okay.
Right? So let me specify that. So let's start with mutual fund. You know that in India, there are 6 crore or 60 million mutual fund investors. And now mutual fund is, because of this MF Sahi Hai, mutual fund is pretty much a household product, right? In a vast country like ours, 6 crore is not a lot, but yeah, considering taxpayers and, all of those, 6 crore is a reasonable number. So given that mutual fund is 6 crore, it will become 10 crore, 15 crore, 20 crore. The regulator is very, very cautious, and rightly so. In mutual funds, somebody as little as 100 rupees right up to hundreds of crores might be investing in mutual fund. So as a result, the regulator has made mutual funds very simplified, straightforward, standardized. What is large cap, top 100 stocks, where you can invest. Okay, large cap fund has to put 80% in 100 stocks. What is mid cap? What is small cap? How much you can buy per share? How much derivatives you can use? Can you do long, short, hedging? So long story short, basic point is that in a mutual fund, everything is standardized. The regulator wants it to be as simple as possible, so that even a 100 rupee person or 100 crore people with knowledge or no knowledge, they will also have some standardized experience. But because of that standardization, mutual funds have many restrictions. So if you say that, okay, small cap means stock number 251 to 500 by rank order of market cap, that is small cap. We may not want to run a fund which invests only in those 250 companies, right? We have 35 people in research. We cover more than 1,000 companies. We might want to invest in a company which in market cap rank is number 1,005. And it may be a small company less than 3,000-4,000 crore market cap. So in a mutual fund, there is not much latitude to do that kind of thing. Say, for example, in a mutual fund, there's not much latitude to do unlisted investing like pre-IPOs or venture funds and all. So AIF is something which has immense latitude. In an AIF, you can do venture funds. You can do, private equity. You can do private credit. Mutual funds have daily NAV. So you can subscribe any day. You can exit any day. We cannot have a lockup. In AIFs, you can have lockup. You can have close-ended. We collect money in we draw down, like AIFs collect money in a staggered fashion, right? So we collect money, we close the fund for 5 years. In between, we may have redemption windows, but it's not daily NAV and not daily liquidity. So I can do unlisted investment also. Like it's very normal for us in a AIF to do small cap, micro cap and unlisted, all mixed. Not possible in a mutual fund. AIFs, for example, they can leverage, meaning that you give 100 rupees, on that 100 rupees worth of portfolio, I can take another 30-40 rupees and enhance the portfolio with a higher investment with the leverage, right?
So when you say leverage, how do you do the leverage?
So for example, if let's say we have collected 100 rupees in a portfolio, and let's say we do say we don't do equity investing, but let's say reasonably stable investing, like say REITs and InvITs, which are hybrid instruments. And REITs and InvITs have an underlying earning, right? They keep earning from toll taxes and rentals and those kinds of things. So it's a reasonably secure investment. So it can be pledged to a bank, and the bank can, or NBFC.
Okay.
It can be pledged to an NBFC, and the NBFC can lend against that. So you have 100 rupees worth of securities. You have pledged it to an NBFC. You can raise another 30-40 rupees. You invest that also.
Okay. So there is an
enhance the return.
Interest component will be there.
Yeah, interest will be paid on that.
Okay.
But you will do that only if the yield on the total portfolio is better than the cost of borrowing, which in today's environment is true, because cost of borrowing may be 8%, 9%.
Okay.
Whereas your underlying investment over a holding period might give you 12, 13, 14, whatever it is.
Okay.
So the point is that in AIFs, we can do leverage also. We can borrow and invest on behalf of investors. We can do, like I said, venture fund, meaning there is just a founder and a business idea. There's no business. So right at inception, we are entering. So there are many things in a AIF. It is higher risk, probably higher return also, longer gestation, not abundant liquidity. Like mutual fund, is
Anytime liquid. It's a liquid.
Then, for example, in mutual funds, we have a standard pricing, right? There is an expense ratio, and that's standard. In AIF, depending on size of investment, you can have different expense ratios within the same AIF. You can have profit sharing also, right? So there are many things which can be done in a AIF.
In AIF, we mainly talk about Cat 1, Cat 2, Cat 3, right? So if we can talk specifically, what is K1, all three of this?
Broadly, if you see, category 1 is, like a social impact, venture investing, priority sector investing, which government has designated as priority sector, right? Social investing, impact investing, venture, priority sector. A lot of those long gestation stuff is in category 1. Category 2 could be unlisted.
So that is not listed.
Yeah, no, not listed. Listed typically people do in category 3.
Category 3. Okay.
Yeah. Category 2 could be venture funds or private equity funds or growth stage funds, pre-IPO funds, a mix of listed, unlisted.
So this closed-ended fund means 5-year means there is a possibility that it can extend also in case.
Yes. So category 1 and category 2 will be closed-ended.
Closed-ended, and especially when you invest in unlisted shares.
Yes, we need closed-ended.
If any liquidity is there is a possibility that it can go extend.
Yes, of course.
Period. Yeah.
It can happen, right? I mean, say for example, we said that we will invest for 7 years. We are doing everything right. Everything is fine. But during the maturity, let's say COVID-19 kind of scenario happens, we have done everything fine, but just before maturity, the liquidity is gone and market is down. Yeah. It would be prudent to extend the maturity and do it in a better period.
Yeah.
And of course, it's not something which is autonomously done. For extending the maturity, you need approval of the AIF unit holders.
Okay.
If I'm not wrong, 75% of the unit holders have to give the consent for the extension. The regulator is pretty strict about how you can do extension. You cannot be doing on whims and fancies.
Okay, understood.
Right? Then the category 3 could be open-ended fund also.
Okay.
Cat 1, Cat 2 is closed-ended, long gestation. Cat 3 could be open-ended. Like, there are some people who are running just a listed portfolio. They don't have mutual fund license. They're running a listed portfolio in AIF category 3.
Okay.
Right? So taxation difference also, because in category 1, category 2, whatever tax is incurred, you will just get a statement, and you as a unit holder will have to file the taxes based on that statement. Whereas in category 3, it is not a pass-through, meaning that the AIF scheme will settle the tax as a representative assessee and give you a statement that the tax is paid. So your NAV will be not only post-expense, the NAV will be post-expense, post-tax. So we run category 2 also, category 3 also. That's done for different purposes. And they have different tax implications.
Category 2, what is it in category?
So, for example, we run pre-IPO funds.
Pre-IPO, okay.
Yeah. Then, for example, pre-IPO funds. Then, say category 3, we run not only here, we run category 3 in Gift City also. Like, if you're sitting in India and under your LRS, you want to invest in, say, emerging markets. So that can be done through a AIF, but it is listed in Gift City.
Can you talk in simple words what is Gift City? We have done the videos, but just for this contest, just
Gift City is like India has its own offshore center. By offshore center, what you mean is that it's a different set of laws and different jurisdiction applies to it.
India's free zone.
It's a free zone, free trade zone for India. Like you have DIFC in Dubai, or you have ADGM in Abu Dhabi, or you have Singapore, Luxembourg, Dublin, Mauritius, right? These are free trade zones. Anybody can send money, anybody can take money out, right? So Gift City is India's free trade zone. And what we do there is we have funds both for foreigners or for NRIs to put money into India. Also, we have funds. And for Indians to send money outside, also, we have funds. Now, let's take an example. You said that when NRIs invest, they are mindful of TDS. But if an NRI is investing through an NRE account, then TDS and tax filing comes. But if you're an NRI who sends your money in dollars to Gift City, and from Gift City you invest into India, right? Then you're not in India's banking system. Your money will go in dollars in Gift City. We collect the money in Gift City. Our Gift City fund will invest here in our mutual fund. If you redeem, it will be paid from Gift City. So you send in dollars, you receive back in dollars. You're not touching India's banking system, and there is no TDS or anything that is
So you save the tax there.
Yes, and if you are in a if you're an NRI from Singapore or Dubai, then anyway you don't have taxes in your home country.
Resident country, yeah.
Yeah, so you don't have taxes in India, you don't have taxes in your home country.
Okay.
So for NRIs, it does become more efficient to invest through Gift City.
Okay.
And then now let's talk the reverse. If you're an Indian citizen, but for diversification you want to invest outside, then all those products are not accessible. So what we do, we manage emerging markets funds. India is an emerging market, but there are other emerging markets like China, Taiwan, South Korea, Latin America, Vietnam, Philippines, Middle East. The whole world is open. So we collect Indians under LRS. We collect Indians' money in Gift City, and from Gift City we help them to invest in other emerging markets.
Okay.
So Gift City is a good gateway for foreigners to invest in India in a tax efficient manner, and for Indians to access investment opportunities which are otherwise not available to them.
Okay. Even NRIs also can invest in Gift City for global funds, no?
No, so NRIs, it would not make, they can invest, of course. NRIs can invest in Gift City, and from Gift City, the money can be invested into emerging markets or wherever. Yes, of course. Of course they can.
That is also
Absolutely.
possible. Okay. I think if we ask AIF, you have clearly said that there is a lot of possibility for AIF and, what is there not possible in mutual fund is more of a standard, and here, fund managers has a flexibility to do many things.
Yeah.
And so when we talk about this one, who will be the, what kind of a client will be ready for AIF? Because we have mutual fund there. So what kind of an asset or what kind of a net worth should be there for a person to think about?
See, 2-3 things to keep in mind. First is that an AIF typically has 1 crore as the minimum. You don't, whether it is a Gift City AIF or an Indian AIF, you don't end up paying the entire amount at one go. Generally, we do a drawdown structure over a period of 1 year. So, you might invest 10 lakhs over 10 months. You might invest 25 lakhs per quarter. Or sometimes, we might have a random, like 50 lakhs right now and then 2 tranches of 25 lakhs. Depends on the scheme and depends on the underlying investment, how much it has progressed. But typically, AIFs have 1 crore minimum, and that 1 crore you have to pay over a period of 1 year, generally speaking. Second important thing is that, like I said, if it is a fund which is investing in unlisted or illiquid, like REITs and InvITs and all, it might be close-ended. So you need 1 crore investment for an AIF. Second, it is likely to be illiquid for at least, say, 5 years, right? So you need that 1 crore, and it is probably locked in for 5 years, which means it cannot be a big part of your net worth, because while it will give you good appreciation and good returns potentially, but it cannot be a big part of your net worth because it will be inaccessible to you for, say, 5 years. Or if it is venture fund, 7 years, 8 years, right? So it depends on individual comfort, but I think to lock up 1 crore, to forget about 1 crore for the next 5 years, 7 years, aiming that the 1 crore can become 2, 3, 4 crore or whatever it can become depending on performance. So I would say that if somebody has 10 crore net worth, I'm sure they'll be able to forget about 1 crore.
10% of it.
Yeah, maybe 10%. Not more than 10-15%. I mean, if somebody's net worth is 4 crores and you lock up 1 crore for 7-8 years, they might say, no, I wanted to buy some property. I want to send my son or daughter to US. Now I need 1 crore. I cannot redeem from here. Sometimes, people's net worth might be locked up in a lot of real estate. And then the other net worth is locked up in some AIF. So So they have net worth but no liquidity. All those challenges also can come up. So better be careful.
Yeah, I mean, we need a proper financial planning to
Yeah, you
make
can just, you make a commitment and you're stuck for 5-7 years.
We need to really see that what is the inflow, what is the possible outflow
cash
they may
flows,
need,
yes.
and any important goals like a kid's education or something. is
And
coming
net
up.
worth is one thing. Liquid net worth is completely different thing altogether, right?
And then in this, when we speak about this, PMS also come into picture, right?
Yeah.
So in between AIF and mutual fund. So where do we put PMS, or what is PMS according to you?
See, there are, I mean, you are in the securities business, so you know that the reality is that the history of investing directly in equity is longer and bigger than mutual funds. Even today, when mutual funds are, say, equity mutual funds are, say, under 50 lakh crores, the direct holding of equity stocks in people's demat accounts, if I'm not wrong, is still 75 lakh crore plus. Right, I think 14-15% of our market is directly, or 13-14% of our market is people holding shares directly in their demat account, and mutual fund is less than 50 lakh crores, right, which is less than 10% of our market. So PMS is, it's like managing a direct equity portfolio in your own demat account, but instead of you managing, you are giving power of attorney to a professional portfolio manager. The other important thing is that in a PMS, obviously, each account is separately managed. AIF and PMS, AIF and mutual fund, both are pooled. And your money is mixed in part of a pool, and all you get is units and NAV. In PMS, there is no number of units or NAV. It's your portfolio in your demat account, managed by a professional fund manager. And what you track is the portfolio value. And your demat account and your portfolio in a PMS is separate from my demat account and my portfolio in a PMS. It's not pooled together. Plus, of course, in a PMS, in mutual funds and in AIFs also, the tax computation generally comes at the exit, in Cat 3 especially, and in mutual fund. In PMS, what happens is that every trade, every transaction is taxed as if you're directly investing. Yeah. So there are structural differences. See, but whether you take AIF, PMS or mutual fund, one common thread is there. Ultimately, the return depends on the quality of the fund management and the underlying asset class where you're investing.
Okay.
And these are just different regulatory structures to create different risk-return combinations or different operating experience.
Thank you, sir, for taking time out for all these questions and your wisdom. So what will be your advice to me? How should I manage my clients in this given situation?
No, that is a tough question. Obviously, you've been in the business for very long. But I would say that, look, whether it is you or whether it is me or any of us as professionals, it goes without saying that because we are engaged with the stock market and we have some responsibility, fiduciary responsibility for our clients. So, of course, we need to understand all the, the economics and the math and the science behind what we are talking. But at the same time, I think what is more important or equally important is to help our investors to overcome, emotional reactions. Like Mr. Buffett is quoted to have said that, be greedy when others are fearful and be fearful when others are greedy. So it goes without saying that one of our responsibilities is to make sure that our investors are not with the herd. They're not part of the others. So, how we recommend products, how we sequence the launches of our products, what type of investing experience we impart to our investors, that definitely needs to be countercyclical. Like say, for example, the time to buy gold was maybe a couple of years back. But a couple of years back, if you told your clients that in your financial portfolio you should have gold, they would have said, no, gold doesn't make any return. But now what they'll be saying, gold has gone up a lot. Now what should we buy silver? Right?
Yeah, correct.
In 2024, they must be telling you that, I want to put money in some sector fund or some small cap fund. Maybe now we know that was not the right time. Maybe the right time will be 6 months, 9 months down the lane. Correct? So I think that it goes without saying that we have to be, some level of expertise has to be there for the economics and the maths and the finance. But I think equal expertise needs to be there in understanding psychology and, keeping people away from emotional extremes. Because mistakes are made when emotions get involved. Right? Biggest mistakes are made when you think emotionally or you respond emotionally. And biggest mistakes in investing are definitely made when your emotion gets involved, like greed, fear, envy. They all are emotions, and they all can hurt your investment prowess.
Yeah, I think I'll take it. So controlling the emotion and at the same time understanding the max of economics and see that kind of asset allocation is done in place.
Absolutely.
I think that's an area which I have to. And sometimes when we chase the return, we need to kind of tell them that stop it. Let's little more do the asset allocation in a scientific manner. I think it's a good thing. We try to do that. Sometimes a lot of questions. Sometimes we have worries that is it because a lot of demand, because earlier demand for small cap was too much.
Yeah, absolutely.
And we had a demand for sectoral funds for especially the time of a defense fund or NFOs times and all, like everyone wanted to get in there.
Yeah. But there's a proverb in English which says you have to shoot where the rabbit will be.
Will be.
Yeah, that is very important.
Now we see that where the rabbit is, that is a place where
people are shooting where the rabbit was 2 years back probably. So that has to be, obviously it's just a metaphor. We are not harming animals. There is no disrespect, but it's just a metaphor.
But it really happens when we talk about it, because a lot of people comes when the market is at the peak, when the market is at the down, or market, especially in the nowhere it's going, it's a tension that is it the right time kind of a thing. Okay, so when we speak about this what will be your advice to audience and entire people going to watch this show?
So I think for the audience, I would put it this way that I would take it back to one of the questions, one of the conversations we had, that we are blessed to be in a scenario where the best of our economic growth is in front of us. We have a large and thriving local economy. And thankfully, we also have the economic structure and the market structure and the law of the land, which will enable us to capture economic growth into our portfolios. Now, this is not a T20 match. You don't have to score 200 runs in the next 2 hours. No. You have to just be on the pitch and play for as long as you can. Because on an average, every 5 years, the index itself has doubled. In good times, maybe 3-4 years. In bad times, maybe 7-8 years. But on an average, every 5 years, index itself has doubled. So if index itself doubles every 5 years, we're not even talking about good mutual funds or your AIFs or private equity. Just the index like Sensex Nifty, on average, if that itself doubles every 5 years, then what more you want, right? So all the prizes are for staying on the pitch and not losing your wicket.
Okay.
There is no prize for doing it faster. Like somebody once told me on a lighter note that if creating wealth take 15 years, but if you're in a hurry, it will take you 25 years. So there's no point in being in a hurry. The longer you stay on the pitch, more wealthy you will be. And there is no gun on your head. There is no timeline. So it's best that you don't do anything which will throw you out of the game or you lose your wicket.
It's a brilliant. I think the people will take a lot of lesson, and there will be a lot of, because what we can do is at awareness, and from there how each of us going to take it as a team, that will help everyone to create wealth. Yeah. Thank you so much, sir, for taking your time out, and keep coming to Kerala. And
Thank you. Thank you very much. Thank you.